Ladies and gentlemen, welcome back to Real Estate Investing with Alex Deacon, where the Deacon of Real Estate himself shares and spreads his knowledge and wisdom and years of experience to everyone listening out there. Alex, what's up, my man?
Adam, good afternoon.
Good afternoon.
Nice to see you.
Nice to see you. Zen Master.
I'm the Zen Master.
We are the Zen Master today, and that's an inside pre-recording joke here inside our studio, like we like to call it here. So, Alex, what it seems like today we're going to dip into the financing side.
Well, yeah, I thought. Well, we could talk about. Like straight up commercial financing, nothing creative, because I think we did one on creative financing.
Absolutely, we did. Check on our list for that.
So this will be just basic lending. You know, this could be for residential. Well, I mean, we can touch on residential. We can touch on commercial and the difference. So yeah, typically there's on residential lending, like if you're buying a property and let's say you're going to live in one half of it. Okay, so it's a duplex. You're buying a duplex. You're going to live in one half, and you're going to have it in your own personal name. Okay. Then you could do traditional residential financing. Traditional residential financing is going to be a little better interest rate. So let's say, I'm guessing, but let's say the current interest rate is 5. It might be for a commercial loan, maybe 5 3/8, maybe 5.5. For residential, it might just be 5. Okay. And for residential, on a duplex, you could probably find a lender. I'm not 100% sure because the rules are changing and lenders have different rules for their particular, lending programs. But I think you can find as little as 5% down. So on a $100,000 duplex, you would have to put down as little as $5,000 plus your closing costs. That might be as high as 10%. Okay. You can also buy a residential duplex living in one half. A duplex, I think, even up to a 4-unit, and you can buy with an FHA loan. If you don't have an FHA loan currently, then because you can only have one at a time, from what I understand. If you have an FHA loan, you can buy with even less money down, and the seller can pay up to 6% of your closing costs. So let's do an example for that $100,000 duplex. Let's say you can buy at FHA. You're going to live in half. You can put 3.5% down. Then you can have the seller pay up to 6% of the sales price, which would be $6,000. So all in, you could probably buy that duplex for your down payment, which is $3,500, and probably another few $1,000s in closing costs. So probably for as little as $6,000 all in, that's with the seller paying $6,000 of your closing costs, you could purchase a duplex for as little as $6,000. Just ballpark.
Okay. Now, is that what they consider house hacking too? That's if you buy.
Yeah, that is house hacking. So
okay.
you like if you buy a single family, maybe live in it for a little bit and then rent it out, and then move on.
Gotcha.
The only problem with house hacking is when you buy it and you buy a single family or a duplex in your personal name, then you go ahead and decide to rent it out. Now it's still in your personal name. So the only problem with that is it exposes you to potential liability for somebody suing you, right, and they can come after you personally. Whereas if you had it in an LLC name, then you're insulated somewhat. For your assets are insulated. Your personal assets are insulated from your company assets because it's in an LLC.
Okay.
So it's not as easy as just switching it over to your LLC, because the bank who lent you the money on the residential side is not going to want or allow you to change it to an LLC and just change the mortgage.
So that's definitely something
you have to refinance it. You have to also, which costs money. That's probably a few $1,000s in refinance costs. And on top of that, you can pay a little higher rate, depending on what the rates are. It might be even a lot higher. Who knows? And you're also going to have to change it from the personal name to the LLC name. So in Pennsylvania here, if you do that, and your property's in not in the city of Pittsburgh, you would have to pay 2% transfer tax. So on that $100,000 duplex, you're going to have to pay 2% transfer tax because you're transferring it from Alex-Deacon to Alex LLC.
Right.
It's just like selling it to another person.
Right. Even though that's
so that cost there could be $4,000 or $5,000 just in costs to transfer it from your personal name to your LLC. So you need to think that through and figure out what your plans are when you initially buy it and how you want it deeded. Do you want it in your company name or not? The advantage of having it in your personal name, it's safe. You can get in for as very little down. The disadvantage is as you grow, your liability exposure gets larger, and you want to put these properties in an LLC name or an LP or corporation or something, and to do that, there's costs involved.
Okay.
Yeah, so typical residential funding, even on a single-family home, like if you want to buy it and just live there, it's just straight-up non-investment, whatever. There's a couple different options. FHA is the option that allows you to get in with as little money down as possible, like 3.5%. And then there's conventional financing, conventional loan. You can absolutely do 5% down on a single family, and I think most duplexes. The only difference with conventional is the seller is only allowed to pay 3% of your closing costs, not 6%, like on an FHA loan. Okay. The only way the seller can pay 6%, in most cases, again, there are some banks that might do a 10% down program, and the seller can pay 6% of your closing costs. But just generally speaking, you'd have to put down 20% down on a conventional loan, and then the seller can pay 6% of your closing costs. So I hope for all you folks out there who don't like math, this isn't blowing your mind, but it's really pretty simple.
I think if they don't like math, they're probably in the wrong business too.
It's very simple. But if you're buying anything, you want to get a good agent and a good finance person who can explain this to you. A lot of agents don't even know this. I mean, they literally couldn't even do a cost sheet for you. And that's when I started. We did our own cost sheets. You don't do that anymore. You just have your mortgage person do a good faith estimate for your client, or your client just calls the mortgage company and they do a good faith estimate. That's actually a law that they have to do a good faith estimate for you, because their good faith estimate has to be somewhat close to what it actually is going to be at closing. Because there was a lot of predatory lending going on, and they do a cost sheet for you or a good faith estimate, and let's say you need $8,000 down, and then you get to the closing table and it's $12,000. You can't do that. You can get big trouble.
Right. And we're cheap plug time. We have an affiliate in the mortgage department here in the Pittsburgh area. So if you're in the Pittsburgh area, Terra Mortgage Services.
That's correct.
Is a great service to use. So definitely check them out.
Yeah, Terra, T-A-R-A Mortgage.
Yep. Cheap plug, ladies and gentlemen. Now we can go on.
Good job.
Thank you, sir.
And so we talked about the conventional financing. We're going to go into commercial financing. So anytime, if you buy a 1 to 4 unit in your personal name, it's considered non-commercial. I'm pretty sure of that, non-commercial. If you buy anything in an entity name, if it's Alex LLC or Adam LP, whatever it is, if it's an entity, it's automatically a commercial loan, whether it's a 1 unit or a 1,000 unit apartment complex. So as soon as it's an LLC or incorporated, now it's a commercial loan. Commercial loans are just a little different. They use some different rules, and most likely I haven't found any that are going to require less than 20% down. Some will require 25 or 30% down. Now that would depend on how financially strong you are. Like if your credit score is super good and your cash flow is good and your debt is low and you have experience in this industry, then you'll probably get the best terms possible. Yeah. So for example, let's talk about buying a $200,000 duplex. You're going to put 20% down. That's $40,000. On top of that, most commercial lenders will allow the seller to pay some of your closing costs. We just did one recently where the seller was able to pay 6%. So in this case, you could purchase that $200,000 duplex with $40,000 down. You would essentially just pay, instead of paying the seller $200,000, you would pay them $212,000. The seller would then pay $12,000 of your closing costs. So at the closing, the seller's not giving you a check. All that's happening is the seller side of the settlement sheet it'll have $212,000 as a sales price, and then there's a line item right under it somewhere that says minus $12,000 in seller's assist. Then on your side of the settlement sheet that has all your numbers, you'll have the sale price of $212,000, and then you'll have like 20% down, your closing costs, title insurance, homeowner's insurance, prorated taxes. Those are all liabilities. At some point you'll have a credit on there, and that credit will show as $12,000 seller credit. So that just allows you to, instead of coming up with, let's say you needed, I'm just going to pick a round number, let's say you needed $56,000 to buy the $212,000 duplex, $200,000 duplex, $56,000. If you did it this way, you could buy that same $200,000 duplex for $212,000, but only have to come up with $44,000.
That's a big difference.
So it's $12,000 more you're paying, but remember that you're just getting that back.
Right.
But it allows you to buy this duplex with $44,000 instead of $56,000. So how important is keeping that $12,000 in your bank account? Or maybe you don't have that. Maybe you only have $45,000. So there's no other way to do it. Because the $12,000 amortized over 20 years, that's another thing too that's really important, is most commercial banks, maybe there's a few out there that might do single families or duplexes amortized over 30 years, but I haven't found any. Most of them are at amortized over 20 years. So, for example, let's look at that $200,000.
Such as the terms of the deal stretch over 20 years. That's
Yeah, exactly. So the loan amount, if it was a $200,000 loan and you put 20% down, your loan would be $160,000.
Yep.
And I'm going to put in 5% interest over 20 years. Your payment would be $1,055.
Your brain's like a calculator, you know that?
Well, but this thing over here called a computer is very helpful. It's actually $1,000.
You're not supposed to pull the curtain away, Mr. Deacon.
Can't do that. That's actually $1,056. Okay, so let's change that to a 30-year, and it changes to $858. So it changes by $200. Yeah, it's a $200 difference per month cash flow. But yeah, I mean, if you're factoring in your numbers and you're using a 30-year amortization, and then you get to the closing table and it's like, shoot, I thought I was going to make $400 a month cash flow. Now I'm only going to make $200.
Right.
So it's good to know that up front.
Right.
So most commercial loans are amortized over 20 years. You can amortize them over 25 sometimes, but usually 20 or 15. And then usually most commercial banks, a large majority of them, do not escrow for taxes and insurance. At least in my experience. So that, when you buy a house, a lot of times the bank, and you're living there, the bank will escrow your taxes and insurance. So you never see a tax bill, you never see an insurance bill, because they're escrowed into your payment every month. So that $858 you pay, and then they'll add 1/12 of the insurance and 1/12 of the taxes each month. So your payment might be $1,280. Okay? On commercial loans, you're typically going to get the tax bill and the insurance bill, and you pay those when they come due. So your payment would be $858 if it was amortized over 30 years. In this case, it wouldn't be. It would be $1,056 a month, and you'd pay your taxes and insurance when those bills come in.
Gotcha.
So, gosh, I think we covered those. Those are basic
That was detailed. That was 2 pages of notes on mine.
Yeah.
Since we're breaking fourth walls today.
I mean, that's real basic, and that's pretty much, there's nothing really creative or tricky about it. That's the way like 90% of all banks, in my experience, operate, whether you're buying a single-family home to live in or a duplex to live in and then move out in a couple years, or you're doing commercial lending. That's the basic framework that hasn't changed in quite a long time. There are some nuances and some differences in some banks that you might be able to get a little bit creative with and have the seller pay some of the maybe hold a second mortgage, but that's more on the creative financing podcast that we did.
Yeah, which we and it's a very, very, very informative one. You guys should definitely check that out. And I always like to bring in like the beginner's guide to investing, because I'm just the guy that sits here and kind of takes all this in. But it sounds like, just to kind of recap, the biggest thing is, obviously knowing what you're going to be looking at closing. Number one, that's the big thing. You never want to have surprises at closing with any of these. Number two, if you are going into a duplex with the intent maybe later on to rent or to, with the house hacking and stuff like that, kind of know what you're getting into ahead of time, so you're not, spending more money than you need to long term. Like always look long term and know what know what that final cost is going to be, so there's no surprises, because that sounds like that's what can cause any deal to basically crumble.
Mm-hmm. Yeah, using accurate numbers, accurate rents and vacancies, accurate calculations as best you can get, because they're projected. You never know what's going to come around the corner, but what are fixed is your principal and interest. Your loan is not going to change.
Right.
So at least you can get that right for sure.
Right. Yeah. Should be able to.
So we could call this podcast maybe the ABC or the ABCs of traditional financing. I mean, it's something like that. It's just basic financing 101 that you need to know. And it's very simple. And
if nothing else, it's a great refresher. A lot of times we forget. It's just like in baseball. You need the fundamentals. That's what wins you championships. And sometimes you forget those because you're trying to keep hitting the long ball. So this is a great refresher, Alex. And for me, it was a great learning lesson. So see, there we go. Everybody wins, ladies and gentlemen.
Wow, I feel so warm and fuzzy right now.
Don't you?
Yeah.
I do too.
Wow.
It must be that Friday feeling. All right, guys, listen, we appreciate you tuning into this episode of the Real Estate Investing with Alex-Deacon. Listen, make sure you're checking us out on Facebook, on Twitter, on Apple Podcasts, Google Play Podcasts, Spreaker. I think Last.fm has our stuff up on there. I mean, just type in Alex-Deacon Podcast or Deacon-Hoover Real Estate Podcast. You will find all the good work Mr. Deacon does right here, the Deacon of Real Estate. Guys, Ian Hoover, one of our other partners here, also does a podcast, the Realtor Nation podcast, where he interviews other real estate professionals. That is also under our umbrella on all the other podcasting services. Apologize for the stutter there real quick. But make sure you're checking those out too. So for Alex, for Ian, for everybody here at Deacon Hoover, and for myself, we thank you so much, and we'll see you next time.